In this video, I would like to discuss about why some of the assets, they have gaps in the prices. And we can see that on the S&P 500 index, you see that you have an entry price here and then there is a gap. And then there are gaps here in between those candlesticks. Then you have another one here and also in other places. And if I switch to bars, so what's happening here is that in this day, the market goes up and it closes here and then it opens higher at a slightly higher price the next day. And this is because in between this close and the open, the market makers, they decide that this is going to be the new opening price. And they can have different reasons for that, for news, overnight news, or any type of economic events. And from here, you'll have to see and investigate how your broker is going to deal with that. Because many brokers, they are just going to give you this price. So they are not going to give you, if you want to enter at this price, because this is when the price crosses the moving average, but they will fill you in at a higher price. And this is going to slightly affect your profits. And you need to be careful because they are also going to modify your stop loss. So they are going to shift everything higher. That's why you need to verify that with your broker. It depends on the broker that you have. And this is not something that I can help you with because brokers are different around the world. There are many of them. Some of them are very sketchy and they cause problems. Some of them, they're not. They're pretty good and they have fixed rules and they respect the rules all the time. And some brokers, they have better solutions to something like this because they combine the S&P, the index, with futures trading overnight, and they give you an asset that has a slightly different price from what you see here on TradingView or on if you Google it. But you need to see that they will also fill you at a better price. So you need to take that in consideration. You need to take the filling price in consideration with your broker. Another solution to this, if your broker offers you futures contracts and you're going to have to investigate and learn by yourself what future contracts or future trading is. So if you go on the barchart.com website, this is a website that offers information about all the assets. And you can also use this as a chart, as a charting tool. You just need to make an account and they will let you use the charts. You don't need to pay anything. And here you have all the assets in the world. So if I go to futures, those are all the futures. You have commodities, prices, currencies. All the assets have futures, have behind them futures contracts. This is something that big traders, big speculators use. And if I go here on the indices, those are the future contracts for the indices, the S&P 500, the Nasdaq, the Dow, and so on. And they would have, if you use a broker that has future contracts, you'll need to discuss with him or know which one to use, because you'll have in that list maybe two assets like you have here. You see this is the S&P, a mini, and the S&P. So you have S&P and S&P two times. But if you see here, this is the September contract and this is the December contract. And those contracts are 4 per year. Here we have September, December. Okay, so there are 2 months between them. When you trade a future contract, first you need to know which contract you are going to trade if you have those two in the list. And this is very simple. Even if you have it in the list of your broker, you can come here on this website and see. If you go on the right, you look at the volume. So the volume means the total number of shares or contracts traded for the day. So everyone, it's here because it's 1 million.1 and this is just 9,000. So everyone, it's here. You look at the volume. So this means that you need to trade September and you need to check when that contract expires with your broker. Usually brokers, they send you an email and they tell you before, because if you have an open trade that you didn't have an exit signal yet, right in that moment when the contract expires, you need to tell your broker to roll over that trade to the next contract. So the numbers are going to change here when November comes, and you need to tell him to roll over your trade to the next contract. So this is just a routine that you have to do. As you can see here on the IC Markets demo account that we use, there are no gaps. So if they don't show gaps, they should give you the right price. If not, you need to discuss with your broker. And if we check here, if we make a comparison between the S&P standard index and the futures contract, this is very simple. From here, from the bar chart, you see this is the contract and this is the symbol ESU 21 for 2021. So I want to show you those one next to each other. Here we have the index and here we have the future contract. If I write here ES, you see those are the futures, and ESU is the September 2021 contract. CME, Chicago Mercantile Exchange, this is where it comes from, all the futures. And this is the price. You see, it moves the same, just prices are different, gaps are smaller. And if you zoom out a lot, you'll see this is when the contract started. So you see the volume was very small at the beginning. There weren't too many people. And then suddenly the people start to trade this contract and the volume increases. This is how you see it. So that's why this is how you know you're on the right contract. And in here, if I go on the 15 minutes time frame, in fact, let's go on the 1 hour time frame and 1 hour time frame here. And if I add vertical lines at exactly midnight of New York, okay, this is just to show the beginning of each day. Now you will see that there is no midnight on this chart. So here we have 3:30, 20 of August, and here we have 23 of August, 9:30. So this is probably over weekend, but let's check another one. So you have 3:30, 16, and then 9:30, 17. So here we miss the time between when the exchange closes and when the exchange opens in the morning. And the future contracts, you see that between the time when the exchange closes, so this is 15:30ish around here, and when it opens in the morning, 9, let's say, this is overnight. And you see it moves overnight, it trades, it's non-stop. It's non-stop Monday to Friday. And instead this one has a gap overnight, so price drops immediately. So you need to see what your broker, how do your broker deals with this, because they might do slippage and they will just move the entry price of your order, or you can use futures tradings and you'll diminish that problem a lot. But you need to test your strategies on the futures chart. Or there are brokers, I've seen at least one broker that somehow they combined this, so overnight, so they had this price in the day and overnight they had the futures price. So this is an issue that everyone has. The simplest way is to just accept it and accept that small diminish in wins. Maybe you can put that in your back testing, so you make sure that your strategy is good. Maybe you can collect double data on your back testing, so you can have the data in case you don't find a broker that will offer you a good price. Or maybe the broker that you find will give you an asset that it's convenient for you. In any case, I think you should be aware of this, so it doesn't come as a surprise when you choose a brokerage. And see you in the next section.